down. We are live and we're about to get started here. Hello, Money. Let me get this thing here working. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagren. Hey, Doug.
Hey, Kirk, it's a Monday morning, so I'm sure that the listeners are half tuned out. And I can tell you this is the best time to listen to us because we're usually a cast of bloopers here. So let's get going. Monday mornings are just a great time to roll on a podcast.
Monday, people are working, Doug.
That's
our Fridays, people are checked out by then. That's why they're listening. But Mondays, we'll see how many listeners we get live on a Monday here. But I don't know about you. It was a fun weekend. Last week we got some skiing in. The only time I've been skiing all year, and unfortunately, I don't know if I can blame it on global warming, or maybe it's just the fact that it was a little warmer this year. But either way, got a skiing in. It was very icy in New England fashion, and that's probably it because it's looking at 60 degrees for pretty much the next 10 days. So
it's incredible. Yeah.
Yeah.
We finally bought a ski pass this year and didn't use it at all. So, because it's been 40s and 30s and, it's crazy. So I was, talking to you before the show, there was a festival this weekend. It's usually at the fairgrounds outdoors and it can be a little chilly. Normally sometimes -10 for those that really want to brave it. It was a balmy 40 degrees this weekend. So for here, that was like, people were showing up in shorts. And then Sunday was great. My son crossed over from Cub Scouts to Boy Scouts. For anybody out there that's been in scouting, the Arrow of Light, Blue Gold dinner where they cross over and join. So we're starting a new adventure. We're moving on from the kids stuff, from the parent driven stuff to these kids at 11 are gonna have to start making some real hard adult decisions themselves. So if anybody says that scouting's not good for development, I'm watching what's about to come. It's gonna get a little crazy.
So Boy Scouts, is that when they just leave them in the woods by themselves with no food and they have to find their way home? Is that what happens?
There could be part of that. Yeah. The rule of the Scoutmaster is basically, look, this is the time the boys have to make the decisions. I mean, if they're hiking and they're 2 hours off trail, as long as they're not in danger, you let them figure it out. They take care of everything, organize everything. Basically, his rule is my job is to make sure you don't kill yourself. That's why I'm here. Other than that, it is up till that. It is up to all of you to work this out and figure it out together. So you start to respect when someone gets Eagle Scout, and I'm on the early end of this, but I've went through my business partner's son just finished Eagle Scout. I can see why it's highly respected, why there's automatic scholarships for college for Eagle Scouts, because with what they're going to go through over the next couple of years, a lot of people complain about the youth and responsibility. Anybody coming through this program that gets Eagle Scout needs to be commended because it will take an immense amount of responsibility, organization, and dedication to achieve it. So we'll see how we do, but to anybody who's made it to the other end, congrats.
What age do they get to Eagle Scouts, Doug?
I think I'm not exactly 100% sure, but I believe it's something that generally is completed by the time they're 18. So they're on their own pace to get through things. And it's not easy to get through, even if you, remain focused. I mean, starting in fifth grade, the second half of fifth grade at 11. So that's 7 years to get through all of the pieces of components. I believe there's like 6 or 7 levels. They got to get through up to Eagle Scout. Again, leadership is a huge component of that. Planning, organization, all those life skills that help us to truly survive. And yes, being out in the woods. And I think part of the Eagle Scout checklist is exactly what you talked about. We're going to drop you in the middle of nowhere. We may not drop you without a parachute, but we're dropping you and find your way back.
Well, I think my kids need a little of that once in a while.
Yeah.
Every time they start spouting off, be like, you better watch out. We're going to leave you in the woods. You're going to become an Eagle Scout overnight.
They were talking about one of the things coming up is we're actually going to camp inside a cave, like overnight.
Nice.
Like a weekend in a cave. And they said, the Scoutmaster said, Bob, go out to Goodwill, buy a whole new set of clothes. You'll be so muddy, you'll just throw them out. And I'm starting to get intimidated as a parent going on this thing. I was like, I can't imagine, but I mean, it's like, this is going to test me too. I don't know if they do honorary Eagle Scouts for the parents that make it.
I'll tell you, there's one thing I've always wanted to do with the kids and for myself is like one of those wilderness survival things.
Hmm.
Not like they do in the military where they where they live in the Arctic with no clothes and you just figure it out. I'm talking about just like normal everyday, like, hey, I'm in the woods. Like, how can you survive? I thought it'd be a really cool thing to do, but I can't find anywhere around here that does it. It's
Which
just
is
weird.
crazy because where you're at, I mean, there's more forest in the New England area than anywhere else in the country. I mean, it's what's neat about for anybody who's never been to New England. What's neat about it is you'd almost think there was no cities because all of the growth has built up on the East Coast around these cities. Until you get off the exits into the cities, it's just trees everywhere. You'd think there'd be plenty. I mean, you get up to Maine, I think it's what 90% still wilderness. So you would think that there would be outfitters left and right that would be planning something like this. Hey, maybe you're onto something because I know, here in Minnesota, we got the Boundary Waters Canoe Wilderness area where people go in without power and they go up there for days, if not weeks, if as the permit allows. And people are, they sell all these permits every year. They're lined up for it. So I'm sure there's demand, Kirk.
Yeah,
Unless where you're from, life's just a little too cushy.
it's
Being from
true.
Boston, everybody there, it's work hard as long as your helper is working as hard as you are, and you've got people to do the chores and clean up behind you, right, Kirk?
Yeah, we have a lot of yeah, I won't say it. Yeah. Yeah, there's a lot of cushy people around here. Let's just put it that way.
We'll leave it at that.
Leave it at that. Well, let's dive in. Enough of the talk from the Yahoos here. I want to actually start off with something I thought was pretty interesting, which you sent me over the weekend, which was breaking news from the Cleveland Federal Reserve's Inflation Nowcast report, which indicates a significant rise in inflation, projecting it to exceed 5% on an annual basis for February. Now, I don't know about you, Doug, but if you're going from 3.1 to 5, that's going to scare the pants out of a lot of people. And looking at the market this morning, I don't think anyone's noticed. Is it a holiday? Is it a day off today? Because no one seems to have noticed that the potential inflation going from 3.1 to 5. I don't know if that's just the Fed's way of trying to temper future market expectations, but if that's true, that's gonna scare a lot of people.
The
And
Fed doesn't normally come out there and do chart crimes when they make these comments because they control so much of it. And generally speaking, the Fed has been pretty astute with what's about to happen. So you're right. They might be. Alan Greenspan talked about irrational exuberance. We've got that obviously right now with where, certain stocks in the markets are going. We talk about stagflation, right? That 1970s, like we're stagnated, but we've got inflation. Is there a word we can come up with which combines irrational exuberance with irrational complacency? It's irrational explacency. I don't know, because that's what we have right now. We have a combination of it's all going to be awesome and I don't care, right? So
yeah, it's all going to be great. It's just going to go up forever. And this time, Doug, this time is different. This
this time
time is
is
different.
different.
Famous last
Absolutely.
words of any sort of market prediction. This time is different. Remember Kathy Woods? I remember that. And that wasn't too long ago. That was, what, 2 years ago, 3 years ago when
If it
Kathy
means
Woods
anything,
was.
her ETF has been different.
Yeah, I mean, she was on top of the world. Everyone's like, "Oh, just invest in her stuff," and I don't think it's recovered. I mean, it's just been a complete train wreck since. And nothing against her. I mean, I think her thematic approach was correct. Just for whatever reason, well, I'm not going to get into it. I don't want to besmirch people, but basically, I think what's happened to a lot of her stuff is indicative of what we can expect for everything. I think she's taken the brunt of it just because she was on the cutting edge, supposedly, of her ETFs for what they're investing in. But the reality is all the stuff that's going on now. Um, some things are different, and I hate to say that, but you look at like cryptocurrency. That's a technology that's very different. If you look at AI, that's very different. But the trends around that technology are not. And I think we saw it 2 years ago or 3 years ago, whatever it was, when crypto peaked out and then just went down somewhere around 70%, or I think at least Bitcoin was down around 70, some of thereabouts. But most crypto was down similar. And then it's bounced back. It's not at all time highs yet, but it's definitely creeping up there. And you look at AI, which I mean, pretty much the marker of what AI is doing is NVIDIA. And I actually have a fun chart here. There was I guess Eagly on X actually has some pretty good videos which show a historical take, and I'm going to share this one here. I'm not recommending NVIDIA, by the way, but I'm just sharing this because I think it's helpful. And I'm not going to go through the whole video, but it just shows like the blue is NVIDIA and the red is Intel. And Intel has pretty much gone sideways. It was a very mature company and hasn't really grown much, and has actually had its own problems from the lack of growth. However, if you look at NVIDIA, it's pretty much gone nowhere. And then right around 2016, 17, when crypto started to take off and people were starting to buy GPUs for helping with the mining, and then it went up, and then obviously it went down with the crypto craze, went down in like the end of 2008, and then it spiked until the end of 2021, then went down. Same thing with crypto. It's just all backed on crypto. And then right around, was it 2023, AI came out, and all of a sudden it's just skyrocketed through the roof. Now, does this mean it's going to continue to go through the roof? I don't know. I just know that it's going to take them a very long time to come up to a mature level at these prices. And if you look at, maybe they're worth this much, I don't know. But I know based on PE and all the other stuff, they're going to have to continue to grow exponentially. And at some point that stops. Now that may stop 2 years from now. I'm not making a statement about NVIDIA. I'm just showing it as an example, a live current example of speculative booms. And if you see something like this, and I just realized I wasn't sharing the chart at all, like a dummy. But anyway, so this is the chart.
I
It
was
is
just
Monday
waiting
morning.
patiently for you, Kirk. You know.
No, I was sitting there talking about it. I'm like, wait, I'm not sharing this. Okay, now I'm sharing it. Just for all those of you who were wondering what was going on. It's my brain. That's what's going on. So yeah, so if you look at this, it's just spiked, and this is a sign. I mean, you can go back in history. You could look at Cisco, which peaked out in 2000. I don't. Is it Cisco? I think it was Cisco. It still hasn't overcome the peak of pretty much the early 2000s.
I believe
think
it
there
is
were,
Cisco. Yep. It
yeah,
used
and
to
I
be a
think
good
there were
market parameter.
yeah, and there were one or two others too that did that, and they just never overcame their peak. And and I want to show this an example for this reason: is that you look at Intel and it's a mature company. Now, it probably could be growing a little bit better than it has. It's not been a good investment in the last 20 years. I'm sorry, 10 years, just for the fact that it just hasn't grown. If you look at the stock chart, right now, so if you look at mature companies, especially in tech, they get to a place where they have market saturation, and then it's really hard to grow after that, right? If you've got 80% of the market, for example, how do you continue to grow, right? You look at like Google. I think they have, what do they have, like 75, 85% of the search market is probably somewhere in that range. And it's really hard to get that last 15 to 20%, and you won't, because of monopolistic practices. That won't happen. But it's really hard to do that, right? So once you mature, then you have to find other ways to grow your revenue, right? And you look at a company like Microsoft, which has most of the PC market in terms of operating systems. You have Google, which is a monopoly on search engines. You look at these technologies that more or less have a monopoly. It's not a monopoly, but they have the lion's share of the market. At some point, it matures. So then, how do you continue to grow? Well, that's a good question. And so the real question is a stock like this, is it hitting a maturity level where it's going to continue to grow at this rate, or is it at some point, are people going to say, no, this is probably all the processors we're ever going to own? We're not going to percentage wise have that many more. And if they do, maybe it's at another pace. Maybe other companies catch up. There's a lot of maybes, but when a stock goes up this fast, this high, it just makes you wonder, like, what is the cap of a stock like this? Now, I'm going to share something else real quick. which I thought was a great quote that we found. I'll say we, I mean Doug, but this was a quote. I'm not going to tell you who it is. I'm just going to read it, and I'm going to tell you after. What is determining the timing of your shift from bullish to bearish? This is a question asked to a fund manager. And this was basically a fund manager who went from bullish to bearish right before the 1987 crash. So what determined the timing? Well, it was a combination of a number of factors. Valuations had gone extremely overdone. The dividend yield was down to 2.6%. The price to book value ratio was an all-time high. Also, the Fed had been tightening for a period of time. Finally, my technical analysis showed that the breadth wasn't there. That is, the market strength was primarily concentrated in high cap stocks, with the broad spectrum of issues lagging well behind. This factor made the rally look like a blow-off. Now, outside of Doug, why don't you take a guess who actually said that? Well, since we're on radio, since we're on a podcast, I can't leave that hanging pause too much. It was Stan Druckenmiller. Okay. Now, here's a guy who's famous for his market prowess and performance over the years. And he accurately pointed out the same conditions we have now. Actually, the dividend yield is much lower. I think it's like 2.3 or somewhere in that range. Anyway, the point is, when you're looking at conditions like these are prime conditions for the market continuing to go higher, and also prime conditions for the market to go drastically lower. And I point this out because we've gotten to this place where people's expectations are sky high and unrealistic. Now, it's been a long time since we've had conditions that are rational. And I'm not expecting that that'll happen anytime soon, but it might. When you have all the conditions that he pointed out, valuations have gotten extremely overdone. Well, we've been there for a while. I'll be frank. We've been there for a while. So that's one data point. Dividend yields down to 2.6%. Also, we've been there for a while, although we had low interest rates and low inflation, which made that yield very attractive. I think it got down to 2.3, 2.1 on the S&P. That yield was very attractive because interest rates were zero. And so a lot of people just put money into the S&P because, hey, we're also getting a yield from it. Now, price to book value also at all-time high. Fed has been tightening. Now, here's an important one. Now, if the Fed raises rates and also stops printing money, it means they're tightening. And that's what's happening right now. It's actually been happening for the last 2 years. And 2 years ago, it actually had a broad impact in the market. And then people decided at the end of that year, hey, we don't care. We're just going to go all in the market because the Fed's going to bail us out. Did they? No, they haven't done anything since. But the market thinks they're going to. Now, that's happened. It's still happening. Is that going to continue? Well, so far, the Fed has said, we're not going to change tact. We're going to stick on this path. And right now, if that recent Fed breaking news that came out over the weekend, it looked like, if that holds true and we go from 3% up to 5% inflation, look out below. I don't know what's going to happen. Maybe the market's just going to continue to play dumb and say, it'll go back to normal again. And at some point, the market's going to correct itself. I don't know when it is. I just know that based on all this, it should be soon. So we'll see what happens. Maybe they wait till after the election and then the markets crash coincidentally after the election. Who knows? But that's what's going on here, Doug. What are you seeing?
Well, I think what you're talking about is, I think there's some other things that really go into play. First of all, Stan Druckenmiller has recently, or over the last, I think because of what happened back in 87, I think there's a lot of belief that he is more of a kind of a bearish kind of perma bear kind of mentality. But actually his current holdings are very bullish and hold a lot of the things that have been extremely successful as of late, including NVIDIA, right? So keep in mind that, even though he might be looking at tech, that macro level, details, he's also looking at micro level details. And as we've all been able to see over the couple of years, and even though there may be some, macro level headwinds, there's still a lot of micro level tailwinds that have pushed things. And again, we've seen this time and time again where, even though there's lots of things that could potentially break the markets, they will be, they will go on longer than you can be patient. So it doesn't mean, run for the sides and just sit there. I mean, and just wait it out, because you could be waiting a decade of lost wealth as this thing continues to grow. But you still want to be cautious, and you want to stay. And really, as we've talked about before, it's probably one of the prime times for active management that we've seen in the last, 2 to 3 decades. Now, on top of that, though, if we are already starting to see, and we've talked about this before, we're starting to see some significant shifts in the impact of these higher rates in a lot of different areas. First of all, we have seen a decline in employment, although right now, again, just even though there might be those macro level issues that are going on, we're starting to see more and more companies that are doing layoffs. Many of those companies that, those layoffs that get announced are getting announced with, as a clickbait type of a headline. When you see like 20,000 people laid off of a 500,000 employee company, so what, right? I mean, not that it's not so what to those 20,000 people, but from a corporate standpoint, it's a blip, right? But we are starting to see more of an increase in the number of those things happening. And for a lot of companies that we've seen, that there's, they could be very rate sensitive. And we've talked about this before. Technology is very rate sensitive. If it is inexpensive to borrow, if it's inexpensive to access capital, that's going to lead to greater investment. And it's generally correlated to a better performance of, more growth laden companies like technology than it has necessarily value laden companies. So if we're starting to kind of see those things, and there's been this optimism that inflation was coming down, optimism that cash flow was going to get better, we're starting to see more and more signs of credit cards being tapped out. We're starting to see more and more signs of M2 money being finally depleted. Now, going back to the employment, we're still seeing that as people get laid off, they're pretty much able to go into another job relatively quickly. There's enough job hiring demand to absorb. Again, global warming, whether you believe it or not, some of the people, people out there will say, hey, the oceans are the big CO2 absorption. So as long as there's more, the oceans are absorbing that, right? And it's tempering it. Okay. Whether you believe it or not, that's up to you. But the thing about this is that's what's going on with the job, right? So is there a massive spike in job in the employment market? Well, no, not right now, because they're being reabsorbed. But if companies as a whole start to feel more pressure of their own costs, they're going to have to cut somewhere. Okay. Just like you, me, households, it becomes more expensive to do the everyday business transactions. More expensive to pay for people, more expensive to provide benefits for those people, more expensive for real estate, office supplies, all of these things. And then we're starting to see, again, if real estate's being impacted, and we are starting to see some pressure on the valuations there, that's going to lead to, again, more people not necessarily having cash flow. And so we start to see revenues and cash flows get impacted by the lack of capital that people have sitting around, as that's been reabsorbed the last couple of years. The thing is they, again, they're still talking about soft landing, hard landing. If the timing of the increase in costs correlates to the timing in which people rapidly slam up to, and companies, not just people, but rapidly slam up to the time in which the access to cash flow and surplus and access to capital is drained, it could come on very, very rapidly, because all of a sudden you go from great profits, great revenues, people are buying, to boom, a quarter in which all of these things just start to implode and things ratchet down. And that could sometimes, again, come around seasons where they expect a better seasonality, like maybe it's Christmas time, where you're generally expecting that uptick and it doesn't come through. That's when all it can take, with a lot of fumes around, that could take a little bit of a spark. So again, right now, things are still cranking. Okay. The metrics, though, and this is the stuff that Druckenmiller was talking about, the metrics, you start to look at things. What does the technical analysis say? You talked about getting paid, it kind of alluded to getting paid for the risk. We are at some of the great, the lowest equity risk return right now. That means you're not getting paid to necessarily hold things at this value. Now, PE ratios, they've increased. Relatively speaking, the PE ratios and the revenues and the profits for the Magnificent Seven have still continued to be strong. But again, very interest rate sensitive. So watch these things closely, but keep in mind that this could be something that continues to be very hot for some period of time, which is why, as Stan said, you don't look at one thing. You got to look at a number of things, but be ready to be nimble.
Yeah, no, I think that's a great point, Doug. I mean, agility is one of the most important things you could have when as an investor. And all those of you who are buy and hold types or buy and forget, um, buy and hold is one thing, buy and forget's another. And when we were in a market where we had 0% interest rates, you could buy and hold, and you would be rewarded for that because as long as the market went down, they would just crank up the printing presses and push the markets higher, and they would just keep doing that over and over and over again. And right now, we don't have that environment. We have high rates, and they're not printing money. They're, if anything, they're destroying the amount of money in our society right now. So if you look at a lot of the data, it suggests that at the end of March, households are going to run out of money. Now, that is a average and an expectation. I would guess that probably the impact would come around May. Because typically people have access to credit cards and other things. People are tapping into their home equity, which they have plenty of, which I think is dumb. For those of you, I'm getting a lot of emails right now about this. For those of you who think, hey, should I tap into my home equity? No, you shouldn't. Not unless you want to pay whatever it is. It's 7, 10, 12%, whatever the home equity lines are paying right now. Don't do that. It's certainly better than a credit card, but you should never tap into your home equity for your daily expenses, right? If it's an emergency, if you got to fix your roof, okay, that's fine. But generally speaking, you shouldn't be doing that. You should never tap into your home equity unless it's an emergency or unless you're doing house repairs because it's the equity in the house, so it should increase the equity overall. Anyway, it's a really bad time to be taking on debt. Right, if your credit cards are somewhere between 12 and 35% interest rates, if your home equity line is in the 8-10% range, somewhere in there, just be mindful of that. I do want to share this chart though. This is so GMO, one of the larger, more well-respected institutional research firms. They come out with these monthly numbers, and this is this month's number as of the end of January. And this is basically the 7-year expectations. So their prediction is based on valuation, and it's looking at what is the real return forecast over the next 7 years. So they look at U.S. large cap, small cap, international large and small, emerging markets large and small, and then bonds. So the U.S. large
USA, cap, wait, whoa, wait,
not in this chart.
I'm seeing a pattern here, Kirk.
Yeah, not in this chart, Doug. Yeah, so USA large cap has an average real return forecast of negative 3.5% a year over 7 years. So you add that up.
That's 15 to 20%. That's a massive hit.
Nope. Actually, it's more like 25%, Doug.
Oh, you said 7. I thought you said 5. Yeah. Yep.
Yeah,
exactly.
7 years.
Yep.
So
that's even worse.
That's a negative 25% return over 7 years based on current valuations. U.S. small caps, a little more like 14%. But then you go international, it gets higher. In emerging markets, it gets up to the long-term historical equity average, or the U.S. equity average of 6.4. The bonds, the U.S. bonds are 1.3. Emerging market debt is 3.7. Cash is 1.3. So even the cash is outperforming U.S. stocks. So that should tell you something. Now, I point this out, they do one of these every month and they kind of fluctuate. Sometimes it's gotten pretty extreme. We're not at necessarily extreme levels, but I can say that I'm a little bit concerned. When cash is outperforming stocks, that's a bad sign. And we've been talking about this in the show. You can pretty much buy 3-month treasuries at right around 5.3, 5.4%. And that's as close to a guarantee as you can get, as long as you buy it and you don't sell it until it matures. That's, there's no such thing as a guarantee, but that's as close to one as you can get. And so that's very, very low risk investment. And so when you have that outperforming equities, that should tell you something. Do I want to get 5.5% with no risk, virtually no risk, or do I want to get maybe 6 or 7% with a ton of risk? Well, I'll take the cash any day of the week. And you might say, yeah, but I want to be more aggressive. I need better returns. I want to point this out because this comes up all the time. And here's my lesson for the listeners here today is you can't look at risk as a marker of return. I know the academics do, right? More risk, more return. And over a long period of time, that tends to pan out that way. Not necessarily saying that's true. They are correlated, but just because you take more risk doesn't mean you're going to have better return, right? If you put all your money on a 3-to-1 gamble on the Super Bowl, yeah, that's a lot of risk. Is that going to be more return? Well, not if you lose. If you lose, the returns are going to stink. So the point I'm making is generally speaking, if you're making good investments and the higher risk investments over time tend to perform better, that's not necessarily true, right? Because you could say, well, I can invest in penny stocks. Yeah, you can invest in penny stocks, and do they have better returns? Sometimes, and sometimes they go to zero. So higher risk doesn't necessarily mean higher return. What it means is higher return generally means you have to take more risk. It is not a two-way street. Just because you're taking more risk doesn't mean more return, but more return generally means you're taking more risk. So just understand that that is not a two-way street, okay? Because I get a lot of questions of, hey, I want to take more risk because I want a better return. No, you should want more return and be comfortable with taking more risk. Very, very different. And so when people ask, it's always with the suggestion that how can I take more risk? And that's not the question you should be asking. Because sometimes taking less risk will give you a better return. And unfortunately, right now seems to be one of those times where if you look at back, I'll give you a historical example. If you look back in 2000, you were able to get, I think, a 10-year treasury at right around 6%, 6.5, I think is where it was. So if you could get let's call it 6. Let's say you can get a 6% U.S. Treasury 10-year, and you compare that to investing in the S&P 500 in January of 2000 for the next 10 years, you would have lost a lot of money. Now, if you had invested in that treasury at 6%, you would have close to double your money in that period of time. It was 7% would have doubled your money. So not quite, but pretty close. Compared to losing, I forget what it was, 20, 30%. There's a big difference, right? So it doesn't always mean that just because you're investing in riskier things, you get a better return. Sometimes the timing is everything. Actually, most timing is everything. But, we're in one of those situations now where the market is, as Stan Druckenmiller pointed out in 87, is that you have all these metrics that are off the charts. You have a concentration of stocks. So the top 10% of S&P 500 makes up 70% of the returns. The top 6 positions make up 30. It's crazy. Like these, and with Nvidia kind of going through the roof, it's becoming one of the largest companies out there. Should it be? Well, I remember when Intel was one of the largest companies too, and that hasn't grown in the last 20 some odd years. So is it the right thing to invest? Maybe it goes up like 100 times now. I don't know. Maybe it goes to zero. I have no idea. It could be anywhere in between, right? We don't know, and we can't predict that. But you should know that if you're going along on the rocket ship ride, sometimes the rocket ship blows up. So, at some point the rocket ship comes down to Earth. So you just have to be mindful of the fact that if you're getting caught up in the craze of this is going to go to the moon and it starts to go down, maybe it goes down and doesn't come back for a long time. That like many tech stocks, that does happen. And it doesn't mean that the stock is a bad stock. It doesn't mean that they're not going to continue to grow. Sometimes what it means is not going to continue to grow at the expectations that the market has for it. Now, you also remember the tech boom where for like 10 plus years that some of these stocks well exceeded their expectations of growth for many, many, many years. And that could happen too. And my point here is just to point out the fact that if you're going along for that ride, you're taking a lot of risk. You can get some really good returns, but you're also taking a lot of risk. Do I want to invest in a stock that's like has a PE of 200? Absolutely not. I won't. That's just not my style. Some people, that's their style, and they're okay with that, and that's great, right? Let's say next quarter they come out with earnings and they stink. Well, that stock's going to plummet, right? And their earnings may continue to be great, which means the stock will do what it did a few weeks ago, which just keeps going higher. So just keep in mind that when you're trying to find stocks that are momentum based, you're definitely taking more risk. You can get more return, but you're definitely taking more risk. So just when you're looking at investing, just make thoughtful investments. If you're gambling with all your money and you're like 30 years old, you can afford to take that gamble. When you're 65, you can't. So if you're trying to make more money before retirement and you're 65 and you're putting all your money in, Bitcoin and Nvidia, you might want to take a step back and reassess what you're doing. And the best way to invest, I've found, is to assess your risk first. Ask yourself, what is the worst thing that can happen here? Now, if the worst thing is it could go down 70%, like notoriously Bitcoin, Ethereum, and all the other cryptocurrencies do, that is part of what you're buying into when you invest. If that happens, am I going to be okay? And if the answer is no, then you should either not do it or you should reduce your position sizing. Now, reducing your position sizing may mean you make less money. Imagine that. But that's okay, right? So imagine, we talk about this framework a lot. Imagine you invest in ABC cryptocurrency, whatever it is, doesn't matter. And your thesis is it's going to go up 100x. Okay. How much money do you need to put into it to make it go up 100x? Well, if it was me, if I want 100% return on my portfolio, that just means I put in 1% of my portfolio. And if my thesis holds true, my whole portfolio goes up 100% just in that 1% position. So if it goes up 100x, it means your dollar turns into $100. But if it goes to zero, which is always possible, right? That means your dollar goes to zero, which means you only lost $1. But you could make $100. That's a good thesis. I'll take that if the odds are reasonable, like 50-50 or, 1 out of 3 or something like that. I'll take that because that is a good asymmetric risk to reward payout. Wall Street looks for that. That's like the holy grail of Wall Street investing is asymmetric risk to return payouts. And so it's like going to the casino, right? If you can go to the casino and get a 100-to-1 payout and your odds are 50-50, I'm going to borrow, cheat, and steal all the money I can to go to the casino for those odds. Those are great odds, right? And great payout. You're going to make a fortune doing that. But that doesn't happen, right? It doesn't happen normally. So if you're looking at that type of situation, just understand you don't need to put all your money in. Putting in 1% is okay. Because if you lose 1% of your portfolio in a risky investment, the markets go up or down 1% in any given day. So it's not really the end of the world. So you need to figure out what percentage of your portfolio makes sense for that investment. Now, a general theme for traders is never more than 5% exposure in your portfolio in any one single position. Every institutional, famous, historical money manager that's done well, with exception of a few who, like George Soros, tend to be pigs. Like they go all in on things that they're high confidence. But most investment managers will not go above 5% in one position. So if you're above 5% in one position, you have to ask yourself, why am I different than all these really, really smart people? So just keep that in mind. Doug, thoughts here before we wrap it up?
Yeah, I wanted to go back on one thing. There's a couple of charts that are in there, so I don't know if you'll be able to keep up with me on this. But one thing, again, talking about where these markets go and these predictions of -4% for the next or 3-4% for the next 7 years. As I mentioned before about the risks that are out there. There's some, and I also talk about micro and macro risks. Like right now, one of the things that is still real is although M2 money supply and household cash flow is about to run out, projected in March, cash held by corporations currently is at least going back to the late 90s, is at an all-time high. And what that means is as a benchmark. So Michael Arowet, I don't know if I'm saying his name right, but basically showed that cash that corporations had held had been kind of on a pretty steady increasing level, but kind of been following the baseline from just about maybe $1 trillion in total cash held by corporations up until COVID. It had just kind of slowly risen to about 2 trillion. Now, that's I find that really interesting because one of the things that was a talking point back in 2000 and the crash of 2008 is that corp credit leverage, and did they have the cash flow? Did they have the cash flow? Did they have the leverage? Were they capitalized? And the reality is, along that benchmark, looked like they still kind of were. They might have had too much debt. They still held a lot of cash. Since 2000, with a lot of the loans, PPP and other types of loans that came out from the government or whatever the reasons, and I think a lot of scaling back, which absolutely happened. Companies have gotten tighter. You look at the auto dealers, they're now talking about, or the auto manufacturers now talking about maybe keeping permanently less inventory, making things more kind of that Tesla model of, purchased order. They're not spending the cash on massive investments. So we've seen a spike that jumped up to about $4 trillion in cash in corporations that has been kind of bouncing around $4 trillion and actually slowly started to rise back into 2023. So again, even if things get really, really dire and the economic conditions and the inflation are high, if you are capitalized and if these corporations are capitalized, they may continue to be strong or be able to weather a lot of those economic conditions for an extended period of time because they're more capitalized and less leveraged than they were in the past. So for people that are thinking, oh, it's a 2008 timeframe again, probably not. And again, we're hearing less and less of that now. More people are really looking at a comparison to, of course, the 70s with inflation, stagflation. They're also putting a little bit more of a comparison to the end of the 90s, the dot-coms. This is not a credit crisis this time around. This is more of an irrational exuberance combined with inflation and stagnation and apathy towards everything going on, kind of a mindset, which was definitely not 2008. The other thing that we also have as a viewpoint there is, going to inflation. There was a chart that came out from Investopedia about the American dream. The American dream now costs, according to them, $3.4 million. $35,800 is the average cost of a wedding and an engagement ring. By the way, there are studies out there that have shown a correlation between the price of a wedding and divorce rates. I can't remember exactly what it is, but when you start get to the 30,000 plus, the percentage of divorce rate goes up significantly. In other words, they kind of, again, correlation, not causation. They're like, if you're a little too flashy, it might say something a little bit more about what's behind the marriage than, other, credible factors. The average cost of a home with mortgage, $796. You can see here, lifetime car purchases, $250,000 just in paying for cars. Pet care. If you own pets, you're just fleecing yourself financially. About $70,000 in pet care. Family health insurance. I don't think we need to go over that too much. $1 million just for health care. By the way, I believe it was Fidelity that said it, and this was several years ago. It's probably more. $250,000 of your retirement just for health care alone. So if you're not taking advantage of the HSA plan, which is basically a Roth for healthcare and the most tax efficient thing out there, something to consider because it's deductible going in and tax-free coming out. Don't just put it in and spend it. It's not an FSA. Save it for retirement. $500,000 of raising 2 kids till 18. We're screwed, Kirk. Yeah, it's what we're going to do. We made this fleecing financially by having kids. But, again, there's other rewards in it. So if it's just about the money, maybe, again, focus on, things that, what matters versus just monetary. Insurance just for out of pocket. And then you've got college, okay, which is a good segue here because, as I've said on this before, I do college planning. The average cost of a year of in-state tuition, they're now saying with room and board for 2 children, $42,000. So you're looking mid-20s. And actually in most states, the anchor school, the big state institution like University of Minnesota here, or in Ohio State University, it's really closer to 35,000 just for the in-state college. And then you start getting into private. You got to know what you're doing, people. So get the information. We'll talk about that at the end. But the amount needed to retire, actually fairly reasonable. They're saying you only need 715,000 to retire. Most, financial planning calculators will say people need more than that, but somehow people have been able to retire. But again, if we jump from 3 to 5% annual, guess what? That retirement number is going to change. And by the way, it's not free to die either. You think you can just end it all goes away. Nope, you better save up another $8,000 to go out of here. So it's going to cost you to come in. It's going to cost you to leave, Kirk. So
yeah, that's that. It looks like out of that visual, Doug, though, the dying is the cheapest one.
Dying is definitely the cheapest one. So, out of pocket for delivering 2 babies. So it's still cheaper to come in.
I would argue that number is a little low. That's not what we paid.
You've got to be on a really good health insurance plan. If you're a self-employed or small business, it's not the same for working for corporate America or the state of Massachusetts, which I'm sure has incredible benefits. But trade-offs.
HSAs are a lot more expensive delivering a baby, that's for sure. And I will say that the health insurers, I give them a lot of credit. They're great with the actuarial numbers because I have only once, out of having kids for over 14 years, only one time in 14 years have we ever gone over the amount that I can spend before they start paying. Every other time it goes just up to the line, but never over. I'm like, God, is there something else I can have them do? Can we, get braces or something to get over the line? But no, every year so we pay the premiums and we pay the basically deductible up to that point. And it's like, well, well, I guess it's just more money out of pocket when, frankly, the whole system's broken when you're paying this much and you're paying out of pocket. It's just, there's no reason that healthy people should be paying this much.
The libertarian's coming out of you, Kirk. I'm starting to sense a rhino on the other end.
No, it's still in me, Doug. It's still in me. So anyway, but yeah, the whole forcing people to pay health insurance, it's like forcing people to pay renter insurance so that you can replace light bulbs. That's basically what it is. So the whole system's broken, but whatever. I'm not going to go down that rant. I do want to point this out though, because I saw this chart this week and I thought it was great. It showed, I forget who did this. I think it was Altimetry. But I found this on the internet and I thought it was brilliant. So it's basically aggregating the office REITs and the credit cash flow. It basically shows, just to explain to the listeners, it shows 2023, 24, 25, 26, and 27. And it's showing the cash earnings, the gross cash earnings, compared to the cash available for outlays. And it shows debt maturities, interest expense, rental maintenance, pension servicing costs, and maintenance capital expenditures. And basically what it shows is, oh crap, office REITs are going to be in big trouble as an aggregate. And as of this year, it looks like they're going to be able to cover about half of the expenses based on cash available for outlays and cash earnings. Next year, it's the same. Year after that, it starts to get progressively worse. So I just saw this and I was like, all right, if you're thinking of investing in office space, probably not the best time to do it yet. There will be a good time, and it's usually when blood is running in the streets, as the old saying goes. We're not there yet, though. I think we still have a little ways to go before blood's running in the streets with the office streets. Definitely some wind has come out of the sails quite a bit, but we're not quite at the place where people are just giving them away. And that's really the place you want to be. And when we get to that place, it's actually going to be very, very challenging. Because when you get to the place where people aren't investing in office space, now what's actually happening is there's a lot of conversions. So I just saw an office building go up about 5 minutes from my house, and I noticed it was lab space. So lab space, there's plenty of opportunity there, especially in the Boston area, because that's where all the biotech, there's a lot of biotech companies going up, and technology is big here. So office space, not so big. Lab space, yes. Manufacturing, industrial, but office space is going to be a mess. And you can look at some of the big cities and they might be okay, but a lot of the cities, like I think I heard the stat of in LA, right, in Los Angeles, 30% of office space was vacant. And this was 6 months ago. New York, I heard, had a very similar number. Now, it leads me to question, is this trend going to continue? Work from home and whatnot. Do we need all this big office space in cities? And I don't know. I don't know what the question. I don't know what the answer to that is. I would imagine we need probably a lot less of it, but do we need these big, palatial offices that people go to and work from in downtown expensive areas, or could just maybe go to the suburbs and do the same thing, or maybe work from home? One of my friends is an attorney, works for a big law firm, and they have a big, marble entry and all the stuff and the dark wood that you might imagine with a law firm. But he's working from home a lot, unless he's in court or whatever. But why do you have to go to the office? I work from home plenty. I'm working from home right now because I can, right? Because I don't need to go to the office to do the things I'm doing. And so I think as we kind of look at this space, and if inflation keeps going higher, which, we talked about before, the bullwhip effect, it went high and then it's lower, and now it seems to be peaking up a little bit. Now, you had pointed out one chart. I'm going to say this before we wrap it up, and I'm going to let you kind of ride us into the sunset here, Doug. But there's one chart you shared, which is the core price growth since 2020. The core CPI is 18%, gas is 22%, rent's 22%, food is 25%. I don't know how they're calculating this, but food is not 25%. I would say I haven't seen one food item that I've purchased that is up less than 25%, nonetheless at 25%. Some food's going up 100%, 50%. I know everyone listening to this podcast can concur that food prices have not been going down. The total amount we're paying for food is up at least 100% since 2020, at least, maybe more. So I don't know where he's getting these numbers, but it's not the food I'm buying. Maybe it's McDonald's, but it's certainly not every other piece of food that we're buying. So I'm very curious because all the eat out food places are up 80 to 100%. Certainly, if you've got buying from grocery stores, that's up. You have shrinkflation, which they might not be counting because shrinkflation, they're giving you the same price for chips, but they're giving you less chips for the same price. So there's a lot of that going. There's a lot of inflation that's getting hidden. And so I kind of wonder where these numbers come from sometimes, because I don't know anybody who thinks it's 25%. Anyone who looks at their weekly or monthly grocery bills and eat out bills, they can tell you that it's not 25% in the last few years. There's absolutely no way that's true. So, Doug, where can people find more about you as we wrap it up here?
Well, yeah, I would just add one little thing. It definitely wasn't McDonald's, because the Big Mac has definitely outpaced inflation by almost, about, I wouldn't say 2 to 1, but pretty close to that, 1.75 to 1. So, no, that's not where to go. I think it is, Kirk, steamed broccoli. Steamed broccoli has probably gone down in price. And of course, the kids have avoided that, moving to the more expensive things that they don't want to eat. It's kind of like consumer goods versus discretionary. TVs are cheaper now. You don't need them every day. You don't need your steamed broccoli. Go out and eat your greasy food.
The Whole Foods asparagus with a little bow on top has gone up in price a lot, I can tell you.
That's exactly where it is. So, and there's some other really good inflationary charts that we can get into and talk about again, because it's always nice to come back to that. But speaking of inflation, again, college, I mentioned it, I touched on it. Find out, you've got to know what you're getting into here. If we're talking about, so let's say you're looking at a school, and let's say your budget, you can afford maybe to go to a $15,000, $20,000 school. There's some great $20,000 schools out there, but you're looking at a $40,000 school. That's $20,000 more than you can afford. What are you going to do? How are you going to pay for that? You're going to take on debt. You're going to just, if you take on that debt or you overpay that $20,000, if you look into the future, that $20,000 could end up being anywhere from $500,000 to $1 million plus in lost retirement. And all of a sudden, now we go back to the cost of retirement of $250,000, and you just made it 1.5. And now you're working in retirement when it was time to slow down. You've been working all your life for your kids, and you're going to work for the rest of your life if you don't do this right. Okay. It is important to understand It's important to look at the options. It's important to know the tricks and games and what you're really getting on return on investment. Start with the information. You can go to our website, procollegeplanners.com, procollegeplanners.com. You can also find us on Twitter. You can also find us on Facebook. By the way, we are having a webinar tonight, 6:30 p.m. Central. Please feel free, if you want some information, email us at info@procollegeplanners.com. But go download our free checklist. Go download our free report. Get the free stuff. You might as well start somewhere, and that information could be really helpful to saving you thousands and thousands of dollars.
Yeah, no, I think thanks for sharing that, Doug, and thanks for joining us. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth; we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and archive shows. Now we're on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so please do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.